Okay, let's go to work number 8. It has kind of some effects on total stockholders' equity. You're basically being asked what effect, if any, this has on stockholders' equity. So let's take these one by one. If you click on the icon, it says, okay, declared cash dividends of $85 million. Well, when you declare a dividend, all that means is that you now owe it, right? So now you are telling the outside world, we are going to pay this. Declaration does not mean payment yet. It just means declaration. When you declare a cash dividend, you lower retained earnings by 85 million, and then now you acknowledge that you owe this dividend, so you have dividends payable. You haven't paid it, but it's payable. You can see here, this is not a stockholders' equity account. Dividends payable is not a stockholders' equity account. It's a liability. But this is, okay, and retained earnings is dropping. Retained earnings is a stockholder's equity account. It has a normal credit balance, and you're lowering stockholders' equity by 85 million. So decrease 85 million. Pay close attention when working this kind of problem. Notice it says enter the amount in dollars. For example, 10 million equals 10 and 6 zeros. So pay attention to that when you're working this. Let's look at the next effect. Okay, let's look at I should say letter B, payment of the actual cash dividend. So here we declare the dividend. Now we're going to actually pay it. Well, here's the declaration of it. Dividends payable, retained earnings dropping by 85 million, I believe it is. Is it million? Yeah, 85 million. When you actually pay the dividend, you dropped cash by 85 million, and then of course you clear out this payable that you set up to pay the dividend. You will notice when you look at this entry here, this is not a stockholders' equity account, and this is not a stockholders' equity account. So the actual payment of the cash dividend was declared, and when you declare it, that's when stockholders' equity drops, but the actual payment doesn't really drop stockholders' equity, so no effect. Let's look at the next one. Let's look at C. C is a stock dividend, 20% stock dividend. It tells you all this stuff about before the dividend, da 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 da. You can ignore everything after this. A stock dividend, because a stock dividend involves debiting retained earnings and crediting issuance of stock instead of crediting cash, instead of dropping cash, since it involves a lowering of retained earnings and an increase of common stock outstanding and additional paid-in capital, assuming there's a difference between the declaration and the common stock. Again, common stock's always par value times the number of shares issued. You decrease retained earnings, you increase common stock and additional paid-in capital. Stock dividends never increase or decrease stockholders' equity. So make your life easy and memorize that. Let's go to D. A 40% stock dividend, blah, 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 blah. Unimportant. A stock dividend never affects stockholders' equity. You can see here a lot of this stuff is just distractors because once it's a stock dividend, it has no effect on total stockholders' equity. Let's look at the next one. Let's look at the next one, E, which E says purchase of 1,800 shares of treasury stock. It tells you par value is $1 on this treasury stock at $15 per share. The question is, what effect does this transaction have on stockholders' equity? Once again, to re-echo what I've said before, the easiest way to answer this question is to ask yourself, what is the entry that is made when you purchase 1,800 shares of common stock, which when your company buys it back, it's called treasury stock. When you buy 1,800 shares of treasury stock at $15, what effect does it have? Well, purchase means cash is going down. So if you take $15, $1,800 shares, you get $27,000. Okay, $27,000 correspondingly gets put into treasury stock. Treasury stock, right? All the stockholder equity accounts have normal credit balances, right? Like this, credit balances. Treasury stock has a normal debit balance. So it lowers stockholders' equity. You see the entry here, you're lowering stockholders' equity by 27,000. Decrease. Let's look at the next one. Okay, on the next one, F, it says, now we're going to sell some of that treasury stock. So we purchased some treasury stock, and then here at a later date, we are selling some treasury stock. It says you're selling 300 shares at $18 per share. When you sell stuff, you get cash. We'll get to that in a minute. And it says the cost of the treasury stock was $15 per share. Remember, the cost, the average cost of the treasury stock you own, that you have retired, that cost is important because it affects the treasury stock account amount that you hit later. Pretty much, you got it pretty much laid out here. The easiest way to answer this is to ask yourself, what is the entry that is made when you sell treasury stock? Well, first of all, let's get our cash entry down. 300 times 18. 300 times 18 is 5,400. You use that cost information, right, the cost of the treasury stock, to get $15 times 300 to get your treasury stock credit, right? Keep in mind when you bought, when you paid, when you had cash as a credit and debit as treasury stock, you had treasury stock sitting as a debit. Here you're working it down, the cost of it, 4,500, and it tells you, just blatantly tells you how much the cost is, $15 per share, so you don't have to compute anything. 15 times 300 is 4,500. The difference, the plug, is $900. Now the question that you put after putting the entry is, what effect does this have on stockholders' equity? Well, cash is not a stockholders' equity account. These are stockholder equity accounts, and you will notice that you have 4,500, you have 900. Now it's just a matter of computing it out. So to compute it out, again, the easiest way to answer this is to just make your entry. So you see here that you got the 300 shares at $18 per share. We got that here, the cash. Treasury stock of 4,500, which it just blatantly tells you what it is, $15 cost times $300 per share. And then the additional paid-in capital treasury stock, 900. Be careful here. There's a tendency to get confused here because additional paid-in capital increases stockholders' equity, right? So everybody's pretty clear on that. Credits to treasury stock also increase stockholders' equity. Okay, it's debits to treasury stock, right? It's debits, like when you buy some treasury stock and you retire stock, you credit cash, right? You credit cash, you debit treasury stock. It's debits to treasury stock that lower stockholders' equity. This is not a debit. This is a credit, right? So this makes stockholders' equity go up. This is a credit, additional paid-in capital. This makes it go up. So the answer to what happens to stockholders' equity is it goes up $5,400. Let's look at the last one. The last one appears to be complex because you've got this kind of funky-dunky stock split. So 3-for-1, so the 3-for-1 stock split, prior to the split, 71 million shares, all this stuff is a distractor. Stock splits, okay, just like stock dividends, not cash dividends, stock dividends and stock splits never have any impact on total stockholders' equity. Pretty easy, huh? Stock splits are really just kind of notation entries where it says, hey, if you have 1 share of stock, we're going to give you 3 shares of stock, that kind of stuff. It's basically a notation entry. It has no effect on stockholders' equity. Think about it carefully. If a company could declare a stock split and make stockholders' equity go up, they'd be declaring stock splits all the time. Hey, we need some more stockholders' equity. Let's just declare a stock split. So you can't really manipulate stockholders' equity by declaring a stock split. It's just kind of a notation entry. I hope you found this useful.